The Fed cuts and signals more to come. Australia's jobs figures today will be watched for signs of strength by the RBA, and New Zealand's economy is expected to have contracted in the June quarter. That's coming up in our 5 Things in 5 Minutes on Thursday, September the 18th. And then, in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes looks at how the global oil trade has shifted following Western sanctions on Russia.
Russia produces about just under 10% of world supply. That is essentially sloshing around at a fair discount to what the global benchmarks are pricing at the moment.
But first, in 5 and 5 with ANZ, the US Federal Open Markets Committee has just cut the federal funds rate by 25 basis points into a target range of 4 to 4.25%. The move was more than fully priced, with some in the market picking a 50-point cut. The closely watched dot plot of projections indicates another 50 basis points of cuts in 2025 and one more in 2026. Here's ANZ economist Bansi Madhavani.
The Fed sees a macro environment as one that of modest growth recovery next year and no recession. Crucially, the unemployment rate is also seen to decline to 4.4% next year from 4.5% this year. That is slightly stronger compared to our assessment because we think at current momentum, risks are that unemployment rate is higher than Fed's projection. In terms of voting pattern that was of interest, barring Stephen Mirren, all members supported a 25 basis point rate cut. Mirren dissented and voted for a 50 basis point cut. We think this decision shows that the Fed's preference is to ease in gradual increments of 25 basis points, which is also consistent with our view.
As of just after the Fed decision at 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.2% and the Nasdaq was down 0.6%. The yield on the 10-year US Treasury fell 3 basis points to 3.996%. Gold was flat at $3,725 an ounce. West Texas oil down 0.8% at $64.03 US a barrel. The US dollar index was down 0.3%. The Aussie dollar up 0.1% at 66.92 US cents, and the Kiwi also up 0.1% at 59.93 US cents. Number 2, Indonesia's central bank unexpectedly cut its benchmark rate overnight by 25 basis points to 4.75%. ANZ economist Crystal Tan says a hold was expected due to an underperforming currency.
Bank Indonesia's stance has clearly shifted towards prioritizing growth. So the central bank stressed the urgent need for bank lending rates to decline immediately, highlighting that high borrowing costs remain a key drag on credit growth and thus the economic recovery. So given BI's stronger pro-growth bias, we now see scope for 2 more 25 basis point rate cuts from here, taking the policy rate to 4.25% by the first quarter next year, if not sooner.
Number 3, Australia's August jobs market report today will be watched closely by the Reserve Bank of Australia for signs of strength. ANZ economist Aaron Luck is expecting jobs growth of 32,500 in the month and the unemployment rate to be steady at 4.2%.
We saw employment growth being quite weak in May and June, and given that things are picking up more recently, we think there might be a degree of catching up, and there is a chance we'll see a pretty solid employment growth figure tomorrow. Our own ANZ Indeed job ads has been quite steady for over a year. Business conditions from the NAB business survey are improving, and forward orders are gaining momentum as well.
Number 4, New Zealand's June quarter GDP data is set to show the economy went backwards in the second quarter. ANZ economist Matt Galt is expecting a 0.4% contraction, slightly more than the Reserve Bank's forecast of 0.3%.
The particular areas of weakness we're expecting to see are in manufacturing and construction, which are both quite volatile industries and quite sensitive to the state of the economy. So given the slowdown in Q2, it's not surprising those industries have responded perhaps the most. But a lot of the large service sector of the economy, about 70% of the economy, looks to have patchy weakness as well. So wholesale trade, for example, relatively weak, and professional services, which is a large industry, also looking quite weak.
Number 5, Japan's exports contracted for the 4th month in a row in August. ANZ FX strategist Felix Ryan says tariffs have seen a weakening in exports of cars and steel to the United States.
In fact, in August, Japan did see the largest drop in value of shipments to the US in over 4 years. That was down nearly 14% year over year. There was a slight increase there in exports to Europe and Asia. That did offset some of that fall in value shipments to the US, but again, still seeing that decline in exports at the headline level.
Felix Ryan there. Now, on part one of a deep dive interview on the divergence in the global energy market, ANZ senior commodities strategist Daniel Hynes looks at how sanctions on Russian oil have affected the global oil trade.
Yeah, it goes a little bit unnoticed amidst all these threats of tariffs and actual sanctions on Russia itself. But driven by the European Union, we've had a price cap essentially placed on Russian oil, which was set at about $60 a barrel. And that essentially meant any buyer of Russian crude could obviously purchase it at that price. The EU has subsequently adjusted that just recently as part of a new sanctions policy and brought the effective price down to about $47 a barrel. But it'll be on an ongoing basis on a sort of a floating formula, essentially related to about a 15% discount to Brent crude, which is one of the global benchmarks. So, this does mean there's a significant amount of oil, and Russia produces about just under 10% of world supply. That is essentially sloshing around at a fair discount to what the global benchmarks are pricing at the moment.
So who's actually buying this oil at rock bottom prices? Because, there must be an awful lot of people who'd like to.
Really, India and China have stood out as the main recipients there. Both have said that they're going to continue to purchase Russian oil. In fact, in India's case, they have gone from virtually purchasing no Russian oil prior to 2022 to now consuming about a third of its imports now coming from Russia itself. So it's certainly made use of the discounted oil, and certainly in China's case, its relationship with Russia has strengthened in recent years, and they've shown support by continuing to purchase Russian oil as well.
And how is this oil getting around the place? Because I understood it was quite difficult to get insurance on the ships, at least.
Yeah, well, Russia has been able to create what they call a sort of a shadow fleet of tankers, a mixture of its own tankers as well as ones which haven't been affiliated or registered in Western aligned sort of countries, which have been able to skirt, I suppose, the sanction on the shipping industry itself. More worrying, I suppose, is on the insurance side, and we do understand a lot of these tankers subsequently, float around the world's oceans with very little insurance coverage. So, the complications, I suppose, if there was a disaster, are quite significant. But aside from the environmental issues, it has enabled Russia to essentially deliver most of oil it produces outside of obviously what it needs domestically.
And it's not just oil as well. Russia, obviously a major gas producer, and it's stopped selling a lot of its gas to Europe. So what's happening with that gas?
Yeah, well, it certainly has seen its piped gas into Europe drop quite drastically, but just prior to its invasion of Ukraine, it did complete a major pipeline into China called the pipeline of Siberia 1. That has certainly enabled it to get some of its natural gas into the Chinese market. It has also quickly expanded its LNG export capacity as well, and so now it's delivering large amounts of liquefied natural gas to major consumers around the world. What's more interesting, I suppose, is at the recent summit between Russia and China, there was an apparent signing of a new pipeline called the pipeline of Siberia 2, which could deliver a significant amount of additional gas into the Chinese market. But considering that, for purchases of Russian gas, they're obviously, looking at, much better terms considering the sanctions and tariffs they are potentially facing. And so that deal involves a heavily discounted price, both to what LNG prices are getting in Asia, as well as even some of the cheapest sort of pipeline gas that Russia is still pushing into Europe.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, September the 18th. Catch you tomorrow with analysis of those Australian jobs figures and New Zealand's GDP data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.